If you invest or plan to invest in the stock market, you will definitely hear the terms index fund and mutual fund. The question now is, what are these two and what are the differences between these two terms? Hello everyone, this is Ricey, and today we are going to talk about the difference between index fund and mutual fund. Now, on a bird's eye view, really, the main difference between the index fund and the mutual fund is the style of management. A mutual fund is an actively managed fund. An index fund is a passively managed fund. Now, let us first focus on the mutual fund. The mutual fund, being an actively managed fund, means that there is a person behind this fund who manages and decides and picks which kinds of stocks or what kinds of securities should the fund invest on, what kinds of companies should this mutual fund be carrying. Now, a mutual fund, being an actively managed fund, charges more fees. This fee is what you call the management expense ratio, or MER. These are the fees that you have to pay to the institution and to the fund manager, because this fund manager decides and picks which investments or which stocks should be included in that mutual fund. It doesn't matter if this fund gives you money or provides you earnings at the end of the year or not. It really doesn't matter. This person who manages the fund needs to be paid. Of course, it is not free, and that's why he works. He needs to be paid. Even if you earn money on this investment or not, this guy can still go to expensive dinners. But there is what you call the fiduciary responsibility. Fiduciary responsibility is that this manager should have the best interest of the fund and the investors whenever he makes decisions on this mutual fund. Mutual fund, being actively managed, has the tendency to be traded more often. And if it's traded more often, then the commission costs are more, the trading costs are more, the loans are more. There are various and many costs involved when trading is done on mutual funds. So that is what you call a mutual fund. What is the goal of a mutual fund? The main goal of the mutual fund is to beat the market or to beat the performance of an index fund. Now, I have to tell you, and I have read many books about mutual funds. It is not proven, it was never proven that actively managed funds or mutual funds or fund manager have had the success to really beat the market or the index fund or perform better than what the market performs at. So yeah, I mean, from myself personally, I do not really invest in actively managed funds. I am more of an index fund investor. And so then, what is an index fund? An index fund is a passively managed fund, meaning there is no fund manager behind this fund to decide on where should the investment or the funds go as an investment. This is designed to track the performance of certain indexes. For example, there is what you call the Schwab S&P 500 index. The Schwab S&P 500 index is designed to track the performance of the S&P 500 index. The S&P 500 index is made up of the 500 top companies by market capitalization. So that's what Schwab S&P 500 index does. It simply follows what is the performance of the S&P 500 index, and therefore there is no need for a fund manager to make decisions on which stocks or securities should the funds of a certain fund be invested on. I hope that I'm making things clearer. I'm not confusing everyone. Another example is the Vanguard 500 index. The Vanguard 500 index is designed to follow the S&P 500 index fund. So what it means is that there is no fund manager who makes decisions on this Vanguard S&P 500 index, because it is designed to track the Standard & Poor's 500 index fund. Whatever is the performance of the S&P 500 index in the market is normally reflected on the performance of the Vanguard 500 index. That's why if you check the performance of the S&P 500 index, the prices and the growth or the decline of this index, and then check it and compare it with the Schwab 500 index and the Vanguard 500 index, you will see that they are a mirror of each other, because the Schwab 500 index and the Vanguard 500 index are all designed to just follow the S&P 500 index performance. And under the S&P 500 index are the 500 top companies by market capitalization. So now an index fund, being a passively managed fund, means it is of lower cost. Its cost is sufficiently lower as compared to a mutual fund, because with an index fund, you do not have to have a fund manager to make decisions over this fund. So that is one, the cost of keeping an index fund is sufficiently lower than a mutual fund. And the second one is that an index fund does not actively trade. It doesn't buy and sell. It simply mirrors the certain index, and therefore it cuts cost even further, because you have to remember, in the stock market, when you buy and sell securities, you have to pay every single time you buy and you sell, and that, when over time computed, that can cost you a lot of money. And that's another advantage of what an index fund does. Now, so there you are, the main differences between a mutual fund and an index fund. I hope I was able to give you a little bit of clarification, and you are not even more further confused of what an index fund is and a mutual fund is. I hope even a tiny bit of clarity was provided to you by this video. If there was clarity, please like it. If there was no clarity, oh my god, do not like it at all. Thank you very much.